Intel reported Q1 2024 earnings back in April. We're late with this analysis, but we wanted to get it out all the same. Revenue was in line with guidance, and net income and earnings per share beat that guidance. Do we think Intel is a buy? Well, maybe. Even though we couldn't find a great deal to be bullish on, their ongoing investments in foundry suggest Intel may have bottomed out. Revenue was 12.7 billion, down 17.4 quarter over quarter, but it was up 8.6% year over year. Gross margins were 41%, down 10% quarter over quarter, but up 20% year over year. Operating profit was negative 1 billion, up 27% year over year, with net income of $381 million, improved by 86% from Q1 2023. Intel's market cap stands at 129 billion. Our income statement bar chart of the last 9 quarters shows that year-over-year data was improved, given that Q1 2023 was Intel's poorest quarter in quite some time, losing nearly 2.8 billion. With sequential comparisons lower, they reported 15.4 billion in revenue in Q4 2023. We can see that net revenue has been contracting by 4% since Q1 2022, where they earned $2 per share and had a gross margin of 50%. Gross profit is down by over 6%. Operating profits and net income growth is not meaningful as they went from a positive to a negative over the 9 quarters. Turning to the revenue by segment, Intel made changes to how it reports its business unit revenue to reflect its operating model, so we didn't include Foundry, Altera, or Mobileye data. Intel's client computing group continues to be the largest revenue generator, reporting 7.5 billion or 63% of revenue, though that is down from 9.3 billion or 53% of revenue in Q1 2022. This business unit has been contracting by 2.3%. The data center and AI unit is down 7.4% in the last 9 quarters to 3 billion or 25% of revenue, down from 6.1 billion or 35% in Q1 2022. Intel is missing out on the AI boom. Networking and Edge came in at 1.4 billion or around 11.4% of revenue, contracting nearly 5%. Taking a closer look at the client computing group, their notebook business continues to dominate revenue, generating 4.7 billion last quarter, about 62% of revenue, contracting 2.6%, however. Desktop earned 2.5 billion, down by 78 basis points from Q1 2023. This is 33% of revenue. Intel is still very much a supplier to personal computers. Let's look at some ratios. Shares outstanding were down by 18 million. Earnings per share was negative 9 cents. Their Q4 2023 guidance was expecting a loss of 25 cents. So believe it or not, this is better than expected. Sales per share were $3, down 17% sequentially, but up 6.4% year over year. Cash per share is $1.63, slightly down sequentially, but down by almost 18% from Q1 2023. Intel has $26 in book value, and its share price is just over $30, giving us a price to book of 1.15. We should probably add a price to book value data point in the future. Earnings were negative, so the PE isn't meaningful. Leverage ratios show the debt ratio at 0.25 and debt to equity at 0.43. Liquidity ratios look good. Current ratio at 1.6, quick ratio at 0.9, and cash at 0.25. Return on assets were negative 79 basis points and return on equity negative 1.38%. Return on capital employed was 0.3% and return on invested capital data wasn't meaningful. The cash flow on the operating side was down 31% to negative 1.2 billion. Investing outflows were 2.6 billion. Financing inflows were 3.6 billion, primarily from long-term debt issuance, and free cash flow to the firm standing at $7 billion. It's still a strong number, but down 16% year over year. Intel does pay a dividend of 5 cents, which has a yield of 70 basis points, though it hasn't been growing. The enterprise value of Intel is 170 billion, which is a 3.3 times revenue, 6.2 times EBITDA, and 24.6 times free cash flow. Intel provided Q2 guidance with revenue between $12.5 and $13.5 billion and earnings per share of negative 5 cents. Not very impressive. Key takeaways on the pro side are free cash flow, though was down, was still good. Enterprise value multiple and price to book value multiple suggest perhaps Intel is undervalued. Maybe a potential takeover target, though we need to check the shareholder structure and any poison pill provisions. Intel has been investing billions in foundries and looks to be preparing for the future. McKinsey expects the semiconductor industry to grow by 7% to 2030, and perhaps Intel does too. Share price is trading just above the 2023 lows, and this could be an interesting entry point. On the con side, revenue, gross margins are contracting. The client computer revenue, Intel's bread and butter, continues to decline. The AI business unit shows that Intel isn't participating in this industry boom. Given where the share price is, we wouldn't sell it if we owned it, but we're giving it a neutral rating. We have no exposure to this company. Like and subscribe.